Good morning, everyone. This is your mortgage market update for Monday, June 22nd. The desk level read this morning is pretty straightforward. MBS are still trading defensively, even though oil has backed off. The 2-year Treasury is around 4.22%, the 10-year is around 4.48% to 4.49%, and Mortgage News Daily showed UMBS 30-year 5.0 near 97.92, down about 0.21. Lenders are not exactly in the mood to hand out generous rate sheets. The important nuance is this. Yes, the Iran conflict still matters because it moves oil and oil moves inflation expectations. But today's rate pressure is not just about oil. Reuters reported the U.S. issued a temporary 60-day license for Iranian oil sales as part of the latest peace framework, and oil has come down meaningfully from the highs earlier this month. WTI had been above $96 on June 3rd and is now roughly in the $76 to $77 area. So if oil is softer, why aren't rates clearly better? Because the market is also repricing the Fed path. Chair Warsh's first meeting landed hawkish. The Fed held at 3.50% to 3.75%. But policymakers' projections shifted toward a possible rate hike later in 2026, and the front end sold off harder than the long end. In plain English, traders are saying, maybe inflation cools on energy, but we still think the Fed could tighten again. Mortgages don't just follow the 10-year, they follow the 10-year plus spread, and that spread is still wide. Freddie Mac's weekly 30-year fixed is 6.47%, MND's daily is 6.58% against a 10-year around 4.49%. That leaves a mortgage to Treasury spread proxy of roughly 2 points. The Boston Fed says the spread stays elevated when prepayment risk, volatility, and lender costs are elevated. Treasury rallies do not pass through one for one. On inflation, the May CPI showed headline at 4.2% year over year, core at 2.9%, with the energy index up 23.5%. The borrower conversation needs to be, rates are driven by a mix of energy, Fed risk, and MBS spread behavior. One good Treasury day does not automatically solve affordability. What loan officers should do? First, lead with payment strategy, not rate prediction. MBA applications were down 3.8% week over week, but purchase apps are still up 3% from a year ago. And pending sales in May rose 4.8% year over year. Buyers are still in the market. They need someone who can structure a deal instead of reading them headlines. Second, product mix matters. The average 30-year was 6.6% last week, but the average FHA 30-year was 6.25%, and ARM share is around 8.6%. Every borrower should see 3 lanes: conventional, FHA, or VA if it improves payment materially, and a seller-paid buy-down or ARM comparison if that lowers the first 2 to 5 years. Third, lock with intent. Inside 21 days, treat rallies like a gift. If MBS opens weaker by an eighth or more, expect conservative pricing. If 30 to 45 days out, float selectively, but only with pre-agreed triggers and same-day check-ins. 3 quick scripts for borrowers. We're not betting on a perfect rate. We're choosing the best payment structure today and preserving refinance optionality later. For realtors, if your seller will fund a buy-down or credit, I can expand the buyer pool immediately, even in the mid-6s. For past clients, this market still rewards action. I can show you an FHA, VA, ARM, and buy-down comparison in one call. Before I go, a quick note. If you're a loan officer looking for more support, systems, tech, marketing, or just someone to run through strategies with, reach out to me at Central Coast Lending. We're building a team that shares intel like this every week, plus provides training on FHA, VA, buy-downs, and that MBS awareness I mentioned. It's how you thrive in a market like this. Give me a call and let's talk about raising your game this summer. That's it for today. Have a great week, stay dialed in, and I'll see you next Monday with the latest updates.